Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, December 18. You are tuned into On Trend, the show designed to keep you on the right side of the trend. Today's show is going to help us prepare for 2019 by understanding what happened in 2018. So we're going to point out some of the big moves and the big events. We had a number of ETFs moving from a new high to a new low in a few months. We had new lows expanding from October to December. We had underperformers all year, and there were three big themes affecting the financial markets. 2018 performance around the globe. So here we've got a PerfChart, and this is year to date, 243 days. Still got about a week and a half left or so in 2018. But we got U.S. stocks, emerging markets, and these are all U.S. dollar-based ETFs. Stocks outside the U.S., commodities, gold, treasury bonds, equal weight REITs, healthcare and utilities, and the dollar. And we can see it's been a tough year for everything except utilities and the dollar, because they are the only two things that are up. We can see the SPY is down 3%. Small caps are down 3 times as much, down 9%. Emerging markets are down even more, over 15%. And stocks outside the U.S. in general are down over 13%. So this is pretty much a global phenomena. You can see commodities are down mostly because of oil. Gold is even down. Bonds are down. And this is very unusual because on a total return basis, treasury bonds are down, TLT and IEF, and so are stocks. So there's a clear something is wrong in the financial markets, basically. Then we can see REITs are down a little bit. Consumer staples didn't offer much defense there. It's down over 6%. So you can see it's been a very bad year for everything except utilities and the dollar. Now, here are some international indexes, and these are, of course, based on the local currency they're in. For instance, the Nikkei is going to be based in yen, so we get an idea of how they're performing in their own currency. But everything is down, you can see, except for the Nifty 50 and the Bovespa in Brazil. And those are priced in, Bovespa would, of course, be priced in Brazilian reals. And, of course, the Indian shares be priced in rupees. And you can see the Russian trading system is down 3%. So it's pretty much across the board. So there weren't many places to hide as far as equities are concerned. If you look at these commodity groups, these are the Bloomberg commodity groups. We've got energy down, livestock, softs down over 20%, agriculture down around 10%, grains down around 4%, precious metals down, and industrial metals down. So as far as groups are concerned, you couldn't hide out in specific commodity groups. Now, when we break it out and we look at some individual commodities, you can see there were a few gainers. Palladium up 11%, natural gas up around 20%, and wheat up 25%. But most commodities lost ground, with lumber losing over 25% so far this year. Now, strength in the dollar has been a theme throughout 2018, and there you can see the dollar is up around 8%. And of course, most other currencies are down significantly. There you can see the Canadian dollar, the euro. We can see the Swiss franc is holding up a little bit better, but it's tied to the euro there. The Swedish krona is down, the pound is down, the yuan is down, the yen is down, but it's down a little bit less because it's kind of a safe haven currency. The Aussie dollar is down, the Brazilian real is down, the Indian rupee is down. And this is an emerging market currency basket that is down. So the dollar is the king of the currencies this year. Now, when we focus on the U.S. stock market, only one of the major index ETFs is up still year to date. That would be QQQ, up 1.63% still. And you can see large caps are holding up better than small caps and mid caps, which are down more there. And we look at the equal weight sectors, we can see that only 3 of them out of the 10 here are up. And that would be technology is up a fraction. We can see that healthcare is up a fraction, and utilities are the clear gainers. So you can see that, even if you can find the ones that hold up, you're not getting any gains because it's hard to diversify out of the equity market during a bear market because correlations tend to rise in a bear market, which is what I think we entered from October to December. The speed at which a number of ETFs went from new highs to new lows was quite astounding, and we'll look at some of these events. So first up, we have gold. And what's interesting is you're basically going from a 52-week high here in January, touch that high again in April, and then a very sharp decline to a 52-week high just a few months later, 52-week low, excuse me, in July. So, gold has been bouncing over the last couple of months, but I still think this is a counter trend bounce. In other words, this is the bigger downtrend here at work. And this advance is counter trend. And if we break out of the boundary of that wedge, say at 115, that would be a bearish development for gold. But right now, gold is benefiting from the chaos that has hit the financial markets. When we look at base metals here, we can see that we had a 52-week high there in April, and then a 52-week low in July, and again in August. And we've kind of been consolidating here, but we haven't had any kind of a breakout, so to speak. Maybe it's some sort of a triangle. And if we break to the downside here, that would be a bearish development. Then we look at ITB. That's the home construction ETF. You can see that it hit a 52-week high there in January, and it moved down pretty much all year, and then really accelerated in September, early October, and hit that new low in October. So it was one of the first to hit a new low. And now it's just consolidating after new lows. Now here's one that went really quick and kind of shook the markets, I think. It's semiconductors, all right? You had a 52-week high there in August, early September, and then plunged into October and hit a 52-week low at the end of October. So that is an extreme change in the dynamics of the market because we went from uptrend to clear downtrend. Because when you hit a 52-week low, you're in a downtrend as far as I'm concerned. SOX took its time, but keep in mind that the SOX was underperforming from March until August before it broke down, and then it broke support here. But, it had a 52-week high there in March, and then it plunged to a 52-week low in October. So that's clearly a negative for the market. And then we look at insurance, all right? When you wonder if something's going on, you went from a 52-week high in September to a 52-week low in October, less than 2 months. And we hit more 52-week lows here. That's how quick this about face has been. We look at biotech SPDR, all right? It went from a 52-week high there in June to a 52-week high in October. So that's about 4 months there from a strong uptrend to a strong downtrend. Then we look at oil, all right? Something clearly shook the markets as far as oil is concerned. We had a strong uptrend, a 52-week high, and then you can see we clearly broke a support level there in the 64 area and moved to a 52-week low in November. So, maybe oil is going to get an oversold bounce, but the long-term trend is down, and clearly there's something going on in the energy markets. Brent did the same, 52-week high to 52-week low. And then when we look at gasoline, it went from a 52-week high in May to a 52-week low in November. So it's really across the board. Well, not across the board, but there are a lot of stocks and ETFs and commodity-related indexes and stuff that have moved from 52-week highs, like retail, a 52-week high in August and a 52-week low here in December, just a few months. So clearly something has changed as far as the market environment is concerned. You look at biotechs, 52-week highs there in August and September, and a 52-week low yesterday. So XOP here hitting a 52-week high in June, and then a 52-week low in November. and that's what they mean. You take the stairs higher in a bull market and the elevator down in a bear market. We can see the agribusiness ETF 52-week highs in September and 52-week lows in December. So clearly there are some big issues in the market. We also saw new lows expand from October to December, and that shows you that the bear market is broadening. All right, these next charts show high-low percent for the S&P 500, S&P Mid-Cap 400, S&P Small-Cap 600, a little further below, and NASDAQ 100. So basically, new highs minus new lows, and you take that difference and you divide it by the total of issues. So that way you can compare it against different indices. And so we can see here, the main point is there are the new lows in October, and here are the new lows in December. We can see an expansion in new lows, more new lows. Same with mid caps, more new lows. Then we look at small caps. We can see an expansion of new lows from around the 17% area to the 23% area. So that tells you that this bear market or this selling pressure is broadening. It's not narrowing. The only narrowing we're seeing is maybe in the NASDAQ 100, where we have fewer new lows than in October. We're also seeing a little bit of relative strength, less weakness in some of the tech-related ETFs, but that is overshadowed by the broad weakness in the other three indexes I just showed you. So now we're going to show the progression of new lows as it started in the summer and then continued in October and December. And when we look at some of the first groups to hit new lows, we can see the copper miners ETF was hitting a new low there in early August and later in August as well. So miners were seriously underperforming. You can see the S&P 500 was moving up here when miners were moving down, copper miners that is. Then we look at gold miners. All right, so this one has been holding up as of late, but, you know, it was hitting a 52-week low there in early August and mid-August and September. So it's getting this bounce, but this bounce is coming from a 52-week low. So I'm not quite ready to jump on the gold bandwagon. Then we look at mid-caps, all right? The S&P mid-cap was one of the first to hit a 52-week low there, just touching it there in the latter part of October. So again, I'm using the 255-day price channel, which is a little bit over 200 a year. It's 252 days to be exact, or 253, but I just use 255 to be safe. But again, you know, there you can see that new high and then a new low just a few months later. So something is seriously wrong in the stock market here. And of course, we have more new lows in December from mid caps. All right, then we look at the finance sector. Right, it was one of the ones that was raising the alarm bells because it was underperforming in September because it was still well below that January high there. And then it hit a 52-week low in October. So that was the big wave of new lows that we had in October when I think the broad market trend did change from bullish to bearish, the broad market environment. So there you can see industrials, a new high in September, and then new low in October and new low in December. So something is seriously wrong with the market when you abruptly go from a new high to a new low. We're repricing for some event coming up in the next few months. All right, materials. XLB was lagging pretty much all year because it peaked in January, had a lower high there in September, and a 52-week low in October. And of course, we've already seen housing hitting that 52-week low in October. So, you know, October was a clear event. All right, we had semiconductors hitting 52-week lows. The SOX, which is the large cap semiconductor ETF, hitting 52-week lows. So this big expansion of 52-week lows in October was what tipped the balance clearly to the bears. This is the Vanguard Finance ETF, 52-week low in October, and again here in December. You know, there's no arguing if you're in an uptrend or a downtrend when you hit a 52-week low. You are in a downtrend. You can talk about divergences and relative performance, but if you're hitting a 52-week low, you're in a downtrend. And insurance, already covered that one, 52-week lows. Regional banks hit 52-week lows there in October, one of the first groups, or one of the groups that was with that October plunge. But you can see that this one broke its 200-day moving average in September. So it was breaking down ahead of time and also underperforming from May to August. It was a lower high up there when SPY was making a higher high. Then we look at biotechs. I already showed these 52-week lows in October and November. Oil and gas equipment and services, October 52-week lows and continuing in November and December. The S&P 500 joined the party here in December. All right, it was holding up in October because it didn't have a 52-week low. And then you can see there that it just went below that low, which is going back to February. This is on an intraday basis. But intraday, the S&P 500 hit a 52-week low. S&P equal weight, no question about this low, all right, clearly below that February low and a 52-week low. This is a very negative development for the broader market. Sure, it's oversold. Sure, the market is ripe for a bounce. Sure, the Fed meeting is coming and the plunge protection team is assembling. But, a 52-week low tells you that the risk is running high in the market right now. And this is the Russell 2000 moving to 52-week lows here in December. Small caps, SML joining the new low parade. Then we get energy hitting new 52-week lows. Another one, a 52-week high in October, and just a few months later, a 52-week low. Then we look at retail. There is a 52-week low. Never a good sign when the most economically sensitive group for the U.S. economy, domestic economy, hits 52-week lows, which retail did in December. So this expansion of new lows from October to December, again, just reinforces the negativity or the bearishness in the market. There's broker-dealers hitting a 52-week low in December for the first time. Transports hitting a 52-week low. FedEx had a major breakdown. Biotechs, I showed this one hitting a 52-week low. Oil and gas exploration and production hitting a 52-week low. The agribusiness ETF hitting a 52-week low. And the dynamic food and beverage ETF. This is supposed to be defensive, but it's hitting a 52-week low. So there are not a lot of places to hide out there, and we're clearly more downtrends, strong downtrends and uptrends. There were also a number of key groups that were underperforming throughout 2018 and providing some sort of a warning. So the German economy is perhaps the engine of Europe, the strongest economy, one of the most dominant economies in Europe. And you can see that the DAX was hitting new lows back in March. All right, there you go, March, April, and then new lows again in October. And the DAX peaked back here in January and had a lower high in May and then lower highs in July, August, September. Now, I wasn't equating that to a problem in the U.S. until the U.S. broke down because, it could be something specific to Europe, so I wasn't trying to make a connection here. But then we look at the Shanghai Composite, all right, and it peaked back in January as well and has been declining all year. So you can see the S&P 500 is moving higher from April until September, and the Shanghai Composite was moving lower. But it doesn't affect the U.S. market until it does, all right? And we did get a signal in October. We got breast signals and all those breakdowns that I just showed you. So as far as China is concerned, it's interesting. It's holding up a little bit here, but we need to get a breakout here to get any kind of reversal in the works here for the Shanghai Composite. And then if we look within the U.S., housing, of course, has been underperforming the entire year because it peaked in January, had a lower high there in June and July, and then a further breakdown in September. So you can see there's the lower high had kind of a descending triangle that was pointed out in arch charts and a clear breakdown to new lows. And then we look at the home builders, which is kind of a mix of home building and home construction and retail. You know, it peaked back in January and was pretty much weak all year. And then we look at finance, XLF, all right? So here's the S&P 500 moving to new highs from April to September. And, you know, XLF didn't bottom until June, and it had a pretty strong move, but just fizzled, all right? And it fell short of the January high, so it's underperforming year to date on any metric. If you went year to date, it was underperforming. And then you had the big breakdown again in September, October, and of course, new 52-week lows. But finance has been underperforming the entire year or trending down. The same is true for the equal weight finance ETF, which of course is not based on just large caps. All right, the S&P 500 was moving higher down here, and you can see finance was maybe flat at best, but below these January, March highs at worst and underperforming until the breakdown and then seriously trending lower. And again, here's the dynamic food and beverage ETF. Didn't even challenge the January highs in the summer and then broke down. So this one has clearly been leading all year long. And Jets, you know, this one has huge counter trend rallies, as you can see, with these, you know, bounces. But each of these bounces is within a bigger downtrend and a series of lower highs and lower lows. So this is weighing on transports. Jets have been weak all year. Oil and gas equipment and services, weak all year. Peaked in January, didn't exceed the peak in May, lower high in September, and a breakdown. Materials underperforming all year. There's the January high, didn't even come close in September, and a clear breakdown. We'll go on to page 2. We look at coal. All right, peak in January and just moving steadily lower throughout the year. Copper miners, peak in January, steadily lower throughout the year. Metals and mining, a peak in January, big choppy range that was drifting lower and then got hit in September and October. So they were underperforming here, and they took one of the biggest hits in September and October. Steel is well underperforming all year. You can see that the S&P 500 was hitting new highs back here in the September and August, and it was already well below that May high, and it just continued lower. So a lot of weakness out there. And then we look at unadjusted bonds, all right, junk bonds. They have been trending lower since 2017. And this is what junk bond holders are getting on capital return. It doesn't include the distributions, which of course are important for junk bonds because they're high, but they were already moving lower in 2017. They moved flat in the beginning of 2018, but look at that decline in September, October. All right, a lot of weakness there. Now we're going to look at 3 themes affecting the financial markets: liquidity, the economy, and what I call the peripheral. All right, when it comes to liquidity, I'm basically watching 2 things. I'm watching the spread between high yield bonds, junk bonds, relative to treasuries. All right, and you can see here, this is the Fed chart, and there we had a big surge in 2016, and then it was declining and kind of flattening out, and it has turned up very sharply over the last few weeks. Look at that move higher. So that tells you the yield on junk bonds is moving up at a faster rate than the yield on treasuries. And that tells you that there is tightness in the credit market because creditors are demanding more money from high yields to take on the risk associated with high yields. Next, I'm on the Board of Governors of the Federal Reserve System website, and I'm looking at the Fed balance sheet. All right, and you can see here that it moved higher in 2013, sharply higher, and into 2014, and then started flattening up. And this was one heck of a bull run there in 2013 for the stock market too. And you can use this slider here at the bottom and you can compress this chart or look at a shorter time frame. And what I've got here is the last, 2018 basically, the Fed's balance sheet has been contracting. All right. And that is a negative for the market. It means less liquidity out there. Next up is the economy, and here's the Citigroup Economic Surprise Index, and I just found this by Googling Citigroup Economic Surprise Index, and the first hit was from Yardeni Research, so I took a look at that PDF here, and you can see it here that the Citigroup Economic Surprise Index has moved into negative territory. So that means there are more negative surprises than positive surprises. Now, I'm not going to follow up the Economic Surprise Index because I would prefer to get my information off of the charts. And I've already showed you the new lows in housing, ITB, retail, XRT, small caps, and mid caps. And I've got a couple ratio charts here. And you can see I've got the IWM TLT ratio, small caps relative to Treasury bonds, and XRT retail relative to Treasury bonds. And you can see that, IWM was outperforming TLT, and so was XRT with a little dip in between. But they have seriously underperformed over the last, since September. All right, so that tells you that bonds are outperforming, and these higher beta, more growth-oriented, more economically sensitive issues like retail and small caps are underperforming bonds, and I think that's a negative for the economic outlook. Now, something that may be affecting the Treasury markets and could affect them in 2019 is the U.S. national debt. And there's an article in Investors Business Daily that talks about this because the debt continues to grow, and therefore the U.S. needs buyers for those Treasury bonds that will be issued. So I think that is a big issue going forward, and we could see interest rates rise just when the economy slows, and the Fed might not be able to do anything about it. If we go to this Google search, I searched the Bloomberg China hack story. Now, this came out back in October, but I think it highlights a potential issue going forward. The ability to put a chip on a semiconductor somewhere way outside the U.S. and get it into a device and into the U.S. as a form of espionage. Stranger things have happened, but the U.S. and manufacturing may have to be rethunk as far as where the U.S. wants to manufacture its semiconductors. So I know there's a lot of debate on this China hack story, but it is one that is interesting to me and I think could affect the technology sector or cause some sort of dislocation in where manufacturing occurs. So where can I find On Trend on a regular basis? Well, if you go to the Stock Charts TV link, which is at the top of every web page, or if your browser's not open all the way, there's a link on the right. And on Stock Charts TV, you can see what's currently playing. And then below, you will see the upcoming schedule. And On Trend is on Tuesdays at 10:30. And if you want to see the replay, you can go down to the bottom and there's a link for watching past shows on our YouTube channel. And you can scroll down this page to see On Trend with Arthur Hill to click on those videos. And for today's video, when it's posted up there, I'll put links to the PerfChart symbols in the comments section. Just a note that Thursday's show will have a 2019 outlook. So that concludes On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.